Just to summarize, for some time now, we've been talking about a move towards the 4,400 range in the S&P 500 before you really got to start getting cautious. And we were easily calling this October 13th low something more than just a bear market rally, which is exactly what we're getting. So what I want to point out is, last week we talked about this imminent breakout towards 4,300 is likely not going to happen right now. I know everyone's getting excited for it. However, I think we have some volatility to deal with in February and probably into early March. And so I want to give you the three scenarios that I see playing out. Hello, everyone. Knox Ridley here, portfolio manager with the IO Fund. And this is our weekly broad market update. And we were going to do an update on Bitcoin. However, because of some of the stuff we're seeing, we thought it'd be more beneficial to do a follow-up with the broad market from what we were talking about last week. So just to summarize, for some time now, we've been talking about a move towards the 4,400 range in the S&P 500 before you really got to start getting cautious. And we were easily calling this October 13th low something more than just a bear market rally, which is exactly what we're getting. So what I want to point out is, last week we talked about this imminent breakout towards 4,300 is likely not going to happen right now. I know everyone's getting excited for it. However, I think we have some volatility to deal with in February and probably into early March. And so I want to give you the three scenarios that I see playing out. The first one is the most bullish, is that, this is your A, B, C, and your C wave is going to be a 5-wave pattern, right? So we already have 1, 2, we get an imminent breakout and just take off to the moon, likely through March, April is when we probably see some kind of a top, maybe June. If we break out from where we are today over 40.95 with volume likely in some kind of a gap, there's no question about it that's what's playing out. And all bearish bets should be, will be put aside. That's the time to go leverage, in our opinion, is whenever you have a third wave move on a large scale. However, what I think is likely playing out at a minimum is this red count, where we are in this C wave, but we're just finishing up the first wave. Instead of finishing here, is topping here. And that would give us a move down towards the 3,900, 3,875 range, likely by mid-February or so. This to me lines up better with what we're seeing globally. Usually in these big third wave moves, you're seeing all markets setting up for some kind of a breakout. And most markets that I look at are not setting up for a breakout, especially the global markets, Europe, which has been very strong and leading in this rally, and some of the biggest stocks in the S&P 500. So the other scenario, which I know no one's really talking about, but I think it has a higher probability than most think, is that we have a move down towards the 3,600 range, 3,700 range by late February, early March. There's a huge cycle cluster coming together in late February. And what that means is usually these mark inflection points. So however you're trending into them is what matters. Usually see some kind of a reversal. So if we are trending hard down into this range, that's going to be your one of the few signals we'll be looking for to start going on a buying frenzy. So anyway, let me go through the evidence on why I don't think we're about to just break out on it, immediately, and looking at some kind of volatility in February. For one, when you compare the S&P 500 in red to the Dow Jones transportation sector to long-dated bonds, an interesting pattern is emerging. So you see how the S&P 500 made a higher high right here. It did so without the transportation sector confirming it, or long-dated bonds. And that matters. Usually when you see a higher high, you want confirmation across key sectors. And this pattern, if you look back through 2022, really marked a lot of bear market tops, or bear market rally tops. I'm not saying that that's what's going to be playing out right now, but it's definitely signaling that this breakout shouldn't be trusted. And if we move over to Europe, I've been talking about Europe for some time. Europe has been leading this market and it is very strong. And there's two ways you can count this. One is this blue count, where we have a clear 5-wave pattern off the low. That's great long term. That's a very bullish sign long term. However, what follows a 5-wave move is a 3-wave move of the same degree. So we're talking about at least a month long second wave move that would take us back into this range. That's about a 10% correction, if not a little more. And if the strongest stocks or markets in the world, which Europe is right now, one of the strongest, is giving you 10% pullback, you can expect the same from the S&P 500 and U.S. markets. At a minimum, I would see it, Europe playing out some kind of an ABC pattern like the S&P 500. And then this is the end of the first wave. And that second wave would take us back into this range right here. That's about a 5 to 7% pullback. Once again, that would be lining up with that red count we were talking about in the S&P 500. But either way you slice this, this is not a breakout scenario. I mean, the momentum is just not suggesting that on multiple patterns that we look at. And the pattern itself is not suggesting that. So we need some kind of a pullback before a breakout. And if we go on to the biggest stocks in the US, take Microsoft, and we'll look at Apple as well. I mean, these stocks account for 11% of the S&P 500. I mean, that's a massive weight. I mean, you take, just Apple alone has more of a weighting than United Healthcare, Johnson & Johnson, Berkshire Hathaway, JP Morgan combined. Some of the biggest companies in the US, like Apple, has a bigger weighting than that. So when you add Microsoft into the mix, you're talking about a giant weight around the S&P 500's neck. So if it's going to be breaking out, we want to see the two biggest stocks in that index doing the same. And what you're looking at here with Microsoft, this is, people, trend lines can get a bad rap because they're relatively subjective. And my way around that is to find the angle that this market is working off of. It's this angle, and then duplicate that angle and put it at other key areas. And every place that you could possibly put a trend line, I put one there with the same angle. And so if we break across above all of these, that's a breakout move. And right now, on weakening momentum, we're barely testing the first of these four right here. So it doesn't look like Microsoft is setting up for a breakout move. If we look at Apple, now Apple just broke out of this trend line, which is bullish, and it's holding above it. However, this pattern right here, you see how this oscillator, this is the composite index. It's basically the RSI with a momentum filter built in, so you can see divergences a lot easier. You see how it's at regions that typically have marked extreme tops within uptrends or even downtrends, and we're there again, except with a much lower price. So you see how the composite index is making a higher high while price is making a lower high. And this is on a pretty big time scale, the 3-day, and you can even see it on the weekly as well. I mean, that's typically a bearish signal that there's more volatility to come. So if Apple breaks back below this trend line, my target is around 122. I know that's a pretty extreme target, but that's the symmetrical move from this top to this bottom. Same move from this top to this bottom, right down in there. And markets love symmetry, especially in corrections. So if we do see Apple get down to 122, which is quite a risky call to be making, that would be another indication to start going on a buying frenzy, in our opinion. However, if Apple, based off its earnings, the Fed speak, just breaks out above this high at 147, that's going to be more confirmation of that blue count. And we'd expect Microsoft to likely catch up. The last thing I want to talk about is the dollar. The correlation between the dollar and equities has really is broken a little bit, and that's fine. That they historically don't have a strong correlation, but they had a very strong one, inverse correlation in 2022. And the dollar is put in a pretty major top, in our opinion, like a multi-year top. And we have a very full corrective pattern. We have an A, B, C. The C wave's a 5-wave pattern, 1, 2, 3, 4, 5. And we're at a really strong support zone right here with very, very strong divergences. So in this larger corrective pattern, A, B, C, all right, we expect, there to be a bounce and then us to make a lower move, probably down into the 90s. I'm not sure when that will happen, but this is what this pattern to me suggests. We have a large degree A wave, B wave, and then a C wave. So we're setting up for this bigger B wave move. And so think about that. The dollar is going to be catching a really big bid. That's usually a fear trade. It's an inflation trade, a fear trade. And so I'm not sure what it's picking up on, but I don't see the dollar continuing to push higher like this with the S&P 500 breaking out and going in the same direction. This is usually meaning some kind of fear is going to be returning to the market. And so the dollar also supports this volatility that we're looking for in February or March. So that's what we're planning for. Like I said before, if we just get an imminent breakout above 40.95, this thesis is scrapped, and we follow the trend, we follow price. Price is the only metric that will make you money. You can have all these wonderful theses and theories on what the market should be doing, but if it's not following the path that you think it should, you have to scrap that and follow price. And for me, the bailout spot is a strong move above 40.95 with the S&P 500. Short of that, we're looking down into February and March, which we will be using as a buying opportunity, and we'll have to see what plays out. But I hope that was helpful. You can sign up for this channel below. We do a YouTube video every single week, just about on various tech stocks, the broad market, as well as some crypto. And we do deep dive institutional level analysis, fundamental and technical, on tech stocks specifically, some crypto and the broad market. And we manage a live tech portfolio. You can sign up there at theiofund.com. Thank you very much, and I hope you have a good week.